moving on, these are the key requirements on AIM as well as the main market. To tell you from a reporting accountant standpoint, a key role, or where we get involved, is around much before you make a decision on IPO, and that is pretty much around restructuring and your tax efficiency and externalizing the structure, which I'll come to in a minute, and Amit will take us through the key challenges that we see around those areas. But pretty much from what we see is reporting accountants will be responsible for the long form report, which is nothing but a financial and tax due diligence, the short form, which is a public opinion, and this is the only item which is public. I mean, all the other bits and pieces that we talk about will be private reports to the board of the new company, as well as the nomads or backers. In terms of short form, is nothing but the historical financial statements of an audit opinion under IFRS, and we'll talk about it a bit later. Then is the working capital statement. There is a working capital statement in the admission document which requires or confirms that for at least 12 months from the date of admission, you have sufficient funds. And we'll come to it in a bit, but the key issue around the working capital model and how it's being prepared is often a challenge for companies. We have in the past spent quite a lot of time helping companies build this model, and also at the same time making sure that they have an appropriate level of headroom when it comes there. Now, the way typically the Indian banking system works, we'll often have, say, working capital facilities, which are 12 months renewed every 12 months with the bankers. Now, to give or to consider these facilities into your working capital model as cash inflows in the future, what we need is a committed statement from the banks that you will be renewing this, or the banks will be renewing these facilities eventually. Now, most of the banks in India, they won't give you that. We've seen in a transaction on a main market where due to this particular issue in terms of working capital model, the transaction was delayed by about 18 months because they took about 18 months to convince bankers in the Indian system. We have worked with the bankers and on some other transactions, and where we planned this effectively well in advance, this has not been an issue. However, this is something that the companies in India need to bear in mind. The reporting format will be IFRS or equivalent. There are a few gaps which are acceptable on AIM, which is IFRS, US GAAP, Australian GAAP, and so on. Most of the companies in India would follow IFRS. If, in terms of the history or the track record, if you have a history for more than 3 years on AIM, you would do a 3-year historic financial statements and an interim stub period. And on the main market, you need the track record, so obviously you need a minimum of 3 years history in this. Except for in case of certain mineral companies where there are exemptions. Your age, or the age of the interim financial statements, as far as AIM is concerned, which you put in the admission document, should not be more than 9 months old. And other rules in terms of not more than 15 years old in terms of your annual accounts. If your annual accounts cannot be more than 15 months old or 18 months old, as the case may be, based on whether your interim information is audited or unaudited. However, your interim financial information or the latest period presented cannot be more than 9 months old in case of AIM, and 6 months in case of the main market. And if you are going for a 144A tranche or accessing the US investor base, then the stub period cannot be more than 135 days old. Some of the challenges, I discussed a few of them. Dual listing, as I mentioned in my first slide, the issue in terms of ownership and structure. Dual listing is not allowed in India, and Amit will speak about it in detail a bit later. But again, how do you externalize the structure in the given time frame by the time you want to list? What are the regulatory implications? What is the tax jurisdiction you need? What is the jurisdiction of the OpCo that you need? So we've seen in the past companies having the jurisdiction of the holdco as being UK PLC for the inclusion in the FTSE 100 index. However, the tax residency could be other than UK. For example, SR had Mauritian tax residency with a UK PLC. Xstrata has a UK PLC topco, but a Swiss tax base. And so is some other companies like Fresnillo and so on. So again, critical to decide what is the topco jurisdiction, both from a tax perspective and again from an investor perspective, because some of the jurisdictions might be tax friendly, but the investors may not like it, like Cayman Islands.